Dirk, thanks very much for joining us from Berlin. Just give us your sense of the, particularly looking at ESG, of how you're seeing that at the moment.
ESG is coming more and more important in the market. So we have seen discussions in the past with the certification of buildings according to a green standard. And now ESG is a very important and also for many investors driven activity. And very important for everybody is the EU taxonomy, which is now in place. That's a clear frame for sustainable investments. And the major difference to the past is we have now a mandatory framework for financial market participants and for EU member states. And this is a very important milestone we have now.
There's obviously a discussion around existing assets versus new assets. How do you see that in this context?
This will be a very important differentiation as for new build assets, for so-called greenfield investments, we can anticipate all of the requirements of ESG. So it's a question of energy consumptions of the buildings. It's a question of the material I use. So we can more focus on cradle to cradle. And also the vision of a zero energy building is something we really can have in place and target for the future. On the other hand, zero energy buildings, much more equipment, much more technical equipment in the buildings will have an impact on the user as well. And here we have to work on the user side as well, so that we fulfill all of the requirements also from a user perspective. Brownfield investments are something different. Here we have still a big uncertainty in place, as certain market participants believe brownfield properties, meaning already existing buildings, have no future in terms of ESG. But I would say the other point of view is right. Existing buildings have already paid for all of the CO2. That means we do not need any new cement, we do not need new bricks and so on. For sure, there's space for development. We have to think about energy consumption. We have to think about how to make those buildings fit to the market. But definitely, from an ESG perspective, an existing building stock is a very big advantage for real estate investors.
And do you think this will start to play into valuations going forward, Dirk, particularly that discussion around embedded carbon?
The embedded carbon, for the time being, is something we see on an accounting perspective, how to calculate and how to calculate the current embedded carbon, and also to make assumptions what is the future carbon emission for existing buildings. However, on the real estate valuation, as we know from a red book perspective, we are still on a very early stage. For that reason, we developed an analysis to compare the capital market with the real estate. We took a look at the capital market and analyzed the view how ESG affects capital market. What are the key drivers anybody can observe? How is the market cap, business enterprise valuation, risk, like it's shown on the WACC, and growth assumption connected? So we started to analyze ESG ratings of real estate companies, defined those who are the leaders in terms of ESG, who are on average, and who are, let's say, the final group. And there's a clear picture coming up that enterprises who are very active in terms of ESG, who started very early, who invested in ESG and also are transparent in this way, have a better growth assumptions, have lower risk and higher values. And this is something where we believe there is a clear connection between a higher business enterprise value and the underlying assets. For sure, there is also something different. Capital markets is more looking on the future development of a company. The asset value is more connected with the current rental income. But for sure, it is not independent. And for that reason, we analyzed how can we bring it to a valuation model. And there are two main factors which we believe. One is the rent and the other one is the yield.
Just explain a little bit more about those kind of key parameters, Dirk.
Market rent, for sure, that's something which is not only depending on ESG, it is also depending on the location, on the demand in the specific market. And for sure, modern buildings equipped with the, as of today's standards, fulfilling all of the ESG criteria are very attractive building. an attractive building have a higher demand and also the potential to be on the prime rent scale of the market rent. On the other hand, the yield is something investor is seeing as the risk in this investment. And when we have buildings fulfilling today's standard, are in line with the taxonomy of the European Union, then you have a lower risk than on average, or even on buildings which are not in line with ESG.
Yeah, it'll be very interesting to see how these valuations begin to develop from here. Thanks very much for joining us, Dirk.
Thank you very much for your questions, Richard.